Welcome to the Financial Quarterback with your host, Jim Lineweaver.
Hi, I'm Jim Lineweaver, your financial quarterback since 1993. As we all deal with continued market volatility, inflation, and other economic headwinds, qualifying dividends can be a great strategy for your portfolio. So here to help me explain the power of qualified dividends is Jerome Sheehan. He's a Chartered Financial Analyst and he's a member of our investment committee. So Jerome, what are the main benefits that you can expect from these qualifying dividends?
Thanks for having me, Jim. There's a few things to keep in mind when considering adding dividend-paying stocks to any investment portfolio. Number one, dividends can be a significant contributor to total return. Number two, they do need to be vetted very carefully, however. And number three, they can have a very favorable tax treatment.
And as you can see on the screen, this table shows just how qualified dividends have contributed to the total return of the S&P 500. In fact, 41% of the total return for the S&P 500, going all the way back 90 years, can be attributable to dividends.
That's true, and there's many different types of dividend-paying stocks, but there's two that I think are particularly timely right now: bank preferred shares and oil and gas exploration and production stocks.
And last week, we talked about the oil and gas, and we know from the number of calls we received that people were really interested. So this week, we're going to talk about the bank preferreds.
Okay, well, I think the bank preferreds are a pretty solid strategy right now for a couple of reasons. Number one, the banks are extremely well capitalized coming out of the financial crisis. Also, there's a number of bank preferreds that are very, very favorably priced right now, and you can lock in a very solid yield for 5 years, possibly longer. And finally, they're an extremely liquid security, so they can be sold at any time.
Yeah, and preferred shares typically decline in price as interest rates rise, so substantial discounts are really already available.
That's true, and if you're able to purchase them at a discount to par, your total return can be even more attractive.
And earlier, you mentioned locking your yield in for at least 5 years, but how likely is it to be even longer?
So I think it's likely to be a lot longer than that. As interest rates rise, it becomes more and more unlikely that the banks will call these preferred shares. And that's because prevailing interest rates need to be low enough to make it attractive for the bank to refinance this debt at a lower cost. And if and when they are called, they're called at par, which is an opportunity for capital gains as well.
Yeah, so that brings us to our final point about capital gains. So whether you use the two strategies we've discussed here or any other dividend strategies, one of the benefits of this is really the tax treatment.
That's true. And currently, qualified dividends are taxed at your long-term capital gains rate. That's between 0 and 20%, depending on your tax bracket. For many investors, that's significantly lower than their personal income tax rate. So makes this a very solid strategy for high-income earners and high-net-worth investors.
Well, that's great. So, Jerome, thanks for joining us to talk about these strategies. If you have questions about your dividend strategy or just want a second opinion on your portfolio, give us a call. We're always here to help. Stay tuned for Fox News Sunday.